Hello and welcome to this Astranti video. Today we'll be looking at the subject of bad debts. This is a particularly important topic because businesses are often owed money which they know will never get paid to them, and you can imagine this could cause havoc in the accounting process. However, we'll also look at ways of how businesses make allowances for these bad debts. This is particularly relevant if you're studying for BA3, as this is a topic which you may be tested on in your exam. However, an understanding of bad debts is also required for your F1 exam. This is an extract from our video on Chapter 7 of our BA3 course. But if you want to see the full video, this can be found on the Astranti website, where you can also access all of our CIMA certificate resources for free. So now let's jump straight in and take a look at bad debts.
Many businesses now offer credit or payment plans, and these encourage people to buy their products now and pay later. So people may not initially have the money to buy the company's product, but with these plans they can still purchase the product with a promise to repay the amount owed at a later date. One of the issues with credit or payment plans, however, is that there can be some uncertainty regarding whether or not the debt in question will be repaid. And as a result, businesses may allocate a portion of their receivables never to be paid off. And this essentially is what bad debt is. So, for example, if someone is learning to drive and they spend all their savings on driving lessons, they may then be unable to afford a car. However, they could buy a car on a credit or payment plan. If, however, they default on a particular month's payment, for instance, or are unable to pay a certain amount of the plan, this then may be classed as a bad debt by the business who has sold the car on the payment plan to start with. So how would a business go about for accounting bad debts? Well, this is what we're going to have a look at in the next section. So if a business becomes aware of the fact that a customer is unable to pay the full amount of debt that they owe to the business, the transaction value in question is removed from the receivables account and is added to a bad debt account. So let's have a look at an example to illustrate this point in a little bit more detail. So the online bike company, which is a company we've come across in a previous chapter, has sold a product to Chris Parker for £200. This sale is on a credit plan, and Chris manages to repay £50 of the sum owed, however is then declared bankrupt and is unable to repay the remaining £150. So when accounting for this bad debt, the first thing that we need to do is debit the initial sale entry into OBC's receivables account, as you can see on the screen at the moment. We then also need to put a credit entry to show the fact that on the 5th of April, Chris repaid £50 of the £200 he owes to the company. And so this shows that the company has received this payment. There would of course be double entries for these transactions in the sales and bank accounts. We're not going to show them in this example, however. The next entry we will see in the receivables account is the fact that the business realises on the 28th of November that this £150 is bad debt. Chris isn't going to pay it back. So we have a credit entry of £150 for this bad debt in the receivables account. The increase in this expense is then showed in the company's bad debt account. So we're going to debit the fact that Chris is unable to repay this amount. So we have a £150 debit entry in the bad debt account. The bad debt entry in the receivables account, so the credit entry we made, balances this account and completely removes this particular receivable from the account. The other thing that we need to do is to ensure that the bad debts are expensed onto the income statement at the end of the year. And this is done by the credit entry you can see on your screen at the moment. So the bad debt account balance is now transferred to OBC's end of year income statement. So how does the company account for the fact that some bad debts may then actually be repaid? So if Chris, for instance, comes into a bit of money and is able to repay the company, how will this transaction be recorded in OBC's accounts? The first step would be to reinstate the bad debt into the company's receivables account. This is, of course, an increase in the company's assets and so is a debit entry. The double entry of this transaction then goes into the bad debts account. So we have a credit entry here of £150. The amount paid back is then shown in the receivables as a credit entry to show that the receivable has been paid off. The £150 in the bad debt account would need to be netted off against other bad debts the company has received in that year. And so the extra expense charged in the previous year will end up being netted against bad debts in this current year's accounts. So sometimes a business will know that a customer will be unable to pay the amount owed back. And how does it go about accounting for this? Well, this is where the allowance for receivables comes into play. As we've just mentioned, when a business knows a customer may not be able to pay back its debts. So for instance, if a buyer defaults on several payments in a row, the business may suspect that the debts will not be repaid. These will be classed as doubtful debts. And there are several ways a business can look to estimate the chances of these doubtful debts occurring. And the first of these methods is through specific allowances. And specific allowances are calculated against a specific individual. So, for instance, if a customer buys a car on a payment scheme for £20,000 and pays back £5,000 of the money it owes the company, but then after that defaults on several payments in a row, the business in question may make a specific allowance on the sale of this car of £15,000 as a doubtful debt. The other method businesses use to estimate a doubtful debt is through a general allowance. And general allowances are applied to total receivables once they have any bad debts written off or specific allowances deducted. Companies will often use an average to calculate these general allowances. So for instance, if a company is owed £1 million in debt and on average 5% of its debts aren't paid off, then it may create a general allowance of £50,000 to cover these doubtful debts.
So we've now come to the end of today's video, and you should now be confident in answering questions on the topic of bad debts. If you want to see the full video, this can be found on the Astranti website, where all of our CIMA certificate resources can be accessed for free. Once you've signed up, you'll not only be able to access this video, but all of our CIMA certificate study texts, videos, exam practice kits, as well as mocks for each certificate exam. Why not also join our CIMA certificate study group on Facebook, where you can share study tips with others taking these exams. If you've enjoyed this video, you should subscribe to our social media accounts. We can be found on Instagram, Facebook, Twitter, LinkedIn, and of course here on YouTube, where we upload new videos twice a week. Thanks for watching.